from late last month.
Under pressure today after two top executives left the company amidst an investigation for inappropriate workplace behavior. This comes as the stock had been on somewhat of a tear, up 15% over the past year, one of the best performing Dow stocks this year. But with problems in the Nike shares were under pressure today after two top executives left the company amidst an investigation for inappropriate workplace behavior. This comes as the stock had been on somewhat of a tear, up 15% over the past year, one of the best performing Dow stocks this year. But with problems in the C-suite and earnings next week, should you just short the stock? Let's get in the money right now. And Dan, you're trading Nike these days, huh?
Yeah, so I don't know if you just short it on an outright basis here, but I think the news today is pretty interesting. I think we're going to kind of become pretty comfortable with these sorts of announcements, meaning like I don't think these stocks are going to get sold off really hard for this sort of thing. I think it was interesting how they positioned this announcement. They said that Parker, the CEO, was going to stay on past 2020 to kind of, I guess, help serve as a little buffer here. So the way I'm looking at this is really about how the stock has acted over the last 6 months or so. It's up about 30% from its 52-week lows made in October. The implied move on earnings next Thursday is about 5% in either direction, which seems pretty hefty, but that's how much it's moved over the last 4 quarters. So really what I want to focus on is a little bit of that premium valuation, that failure at that prior high just from late last month here, and the potential for a lot of good news to be in the stock. So to me right now, I just think that you have the potential for a failure right there at those prior highs. We have a 1-year chart, and I'll let Carter talk about this, but this is what really caught my eye and why I'm going to target a move back to 60 over the next 5 or so weeks. Look at that right there. 60 seems to be a great support level. It seems to be right on that uptrend from those October lows. So right now, just targeting the earnings of that next week when the stock was trading at 66.50, you could look out to April expiration. You could buy the April 65.60 put spread, paying $1 for that, buying one of the April 65 puts for $1.50, selling one of the April 60 puts at 50 cents. Your risk is $1. You break even down at 64 bucks. You can make up to 4 between 64 and 60. I like the risk reward here. I think there's probably a lot of good news in the stock, and I just don't think there's a lot of things that are going to take it up over that breakout level.
There's two sort of critical reasons why I think I really like the structure that you've chosen and the strikes that you've chosen. For one thing, we often talk about how much stock moves on earnings, and that's sort of a one-day look. If you take a look at how Nike has typically behaved for the 1 month that follows earnings, you're looking at maybe a 6 or a 7% move on average. Take a look at the strikes he's chosen. You basically are targeting that move to the downside. The other thing is, why do you want to do a spread going into a catalyst? In this case, you do see slightly elevated options premiums, and options will decay a little bit each day. And if you take a look at the 65 strike that you're buying, that's going to decay about $3.10 a day if you own it, and then when you're selling, it's going to decay about $1.80. So that's offsetting a lot of essentially the rental expense of owning options each day as you own it. So I like the structure a lot.
Let's look at the first chart that Dan had up, which is the issue of where the stock is in relation to where it's been. So the long-term chart, we know that Nike has rallied right back to its highs of 2015. And in principle, a normal condition is after rallying to a prior high, you contend with it, meaning you back and fill. The stock's been doing this now for the better part of 3 months. Normal. So after contending with a high, you either exceed it, it'll be the earnings that do it, or you back away from it. But it's a perfect setup for a very dynamic moment. Now, is it 50-50 making your bet? It's going to be earnings. The one thing that gives me pause about being underweight or shorted is that retail is very poor, and Nike is holding up very well relative to retail. Big moment coming. I'm inclined to bet up, but it's not going to be casual, whatever happens.
Well, that's what makes the market. Mel started just shorted. So the question is, would I be short this stock right here, given what we know about the space in general? We just saw Adidas had a massive rally after. To me, I really like the risk reward. I'm wishing $1. I probably have a probably 45% probability in a week or so of being basically unchanged on this trade. If you look at the kind of the deltas that are in this option structure here, if I get the direction right. So to me, I have 5 weeks for this thing to play out here, as long as it doesn't go the opposite way on a big gap high.
So should you be taking this Nike trade as it is described here? Well, in my opinion, you should not. And there's a couple of reasons for that. Number one, not all stocks are actually good instruments for trading options. And in particular, Nike is not a very highly volatile stock. In other words, the move that they expect in a 5% on a $60 stock is roughly going to be maybe a $2-3 move at tops. So the only chance you have at making a decent return there if the stock moves significantly more than 5% in the right direction. And they specifically clearly state that this is only a profitable trade if it moves in the right direction, which is sort of kind of a gamble. And they describe it as a 50-50% situation. In reality, it is more likely like a 10% type of situation that their trade is actually going to play out favorably, where you will have an actual profit. The reason being, it's not like a roulette table where you bet and it could be black or red. What they're not telling you is the stock could also move absolutely nowhere and it could still trade at a $64 level. In that case, you're not making any money. Okay? It would be the equivalent of a roulette table, not hitting black, not hitting red. It actually hits 0 or double 0. So right there, your chances are not 50-50. They're really describing a proposition at which your chances are 25%. Now, if we look further, the trade is only making money if the move is going to exceed what everyone is expecting, which in this case, 5%. So for you to make any serious money in this trade, the stock would have to really tank. In this particular example that they're given, the stock would have to tank way below 5%. It would have to, ideally go 10 or 15% lower for you to have a real significant substantial return. So with that said, not every stock is good for trading options. And depending on which option strategy you have, yes, some stocks that are not volatile are good for you to possibly use a strategy where you're selling options while you're holding on to the shares of a particular stock. Now, if you're trading options, you want to be dealing with high volatility stocks. And as an individual investor, as an individual trader, one of the best things about options is you want to take advantage of some of the higher price stock. For example, in the event of a $1,000 stock, a 5% move in terms of a net price difference would actually amount to $50. And so even though it could be difficult to actually buy a $1,000 stock, it would be difficult to buy 100 of them, right? If you're not working with a ton of capital. And that's why a lot of individual investors are not looking at these stocks that are priced at $500,000, $1,500, $2,000 a share. But those are the stocks, ideally, that will produce some unbelievable results if you got the correct strategy in implementing some options trading. So if you'd like to learn more on how you can do it, regardless of what is the size of your capital, visit marketcrash.money, click right here on How to Profit, schedule a one-on-one consultation where we will tailor the amount of time that we spend together in that consultation specifically to your goals, specifically to your needs, specifically to what you're trying to accomplish. Now, we are specifically specializing in trading weekly options, and what I mean by that is those options that expire every Friday. We specialize in that, but we also are really good at putting longer term option strategies where you could buy options and have significant results within 2 or 3 weeks, within a month. Or if you don't necessarily want to be an active trader, you can implement some strategies with us where you could actually hold an option for a year and sometimes 2 years. So again, if you'd like to learn more about this and how you can implement some of these strategies, visit marketcrash.money, read some information about possible market crash in 2018, possible Bitcoin crash, and more importantly, how you can take advantage of the stock market crash before it takes advantage of you. Click on How to Profit button, schedule a consultation, take action now. The markets are absolutely awesome. Whether you're trading actively or whether you're trying to put a long-term strategies, the market opportunities are absolutely beautiful right now. Thanks for watching. Catch you on the next video.